Leaders. Real life leaders.
Hey guys, welcome to this week's episode, and I'm so excited for our guest today. He is a world-renowned economist that has been on the Wall Street Journal, the BBC, the British Broadcast Corporation, and he is amazing, and he's going to tell us what's going to be going on in our economy. So welcome, Alex Chausovsky. Welcome.
Chantel. Thank you.
And we also have our amazing co-host, Heather Rimmick and John McLaren.
Hello.
How's it going?
So we are going to just be drilling you with some questions on what our economy is going to be doing. And before we start, I know that ITR is incredibly reliable in their forecast. What is your percentage of the different forecasts that you've done of what is your percentage of being correct?
Sure. I think it's important to address the fact that I'm not aware of any other forecasting firm that really tracks their own track record. But I think it's important as a forecaster, you're basically asking people to trust you about the future. And so we try to be as transparent as possible. So if you look at our results for the last full calendar year for 2018, our forecast accuracy is somewhere around 98 to 99%. But kind of a complete body of work on our part over the last 30 years, we've been tracking this accuracy rating, and we are 94.7% accurate 12 months or 4 quarters into the future. So that's a really high number and really represents the fact that we are a reliable source of information for businesses and for individuals that listen to our input.
So we're going to just be kind of bantering back and forth. Jmac and Heather, just kind of chime in where you feel. I'll start, but kind of tell us, what is your prediction of what is going on with our economy right now? Is there going to be a slowdown, and for how long?
Yeah, we're clearly past the peak in the economic business cycle. That happened in the kind of mid to late last year, depending on which aspect of the economy you look at. GDP peaked in the mid-2018 timeframe. The industrial economy, so companies that are in manufacturing, in the business-to-business world, they peaked a little bit later, kind of in the October 2018 timeframe. And really, when you look at the global economy, that slowdown has been happening since really early 2018. The reason why the US didn't follow suit when Europe and China and Japan all started to slow early last year is because we stimulated ourselves by introducing the tax reform package. So now that we have hindsight, and of course that's always comes with 2020 vision, we see that the impact of tax reform was felt for about 6 months or so. It extended that kind of economic rising trend in the US economy into the latter part of last year. But clearly we've now transitioned through the peak and are on what we call the backside of the business cycle. So that means that the economy is still growing, but it's doing so at a slowing pace over time. And we expect that this trend is going to continue into next year, culminating in what we describe as a cyclical low. That means the bottoming out of the growth rates in the midpoint of 2020. Now, depending on what part of the economy you're talking about, if you're more facing the consumers, so if you're talking about retail sales, kind of some of the things that people buy, so restaurants and going to the movies and furniture, clothing, electronics, all the things that we consume, that will be a slowdown, not a recession. So relatively light growth, culminating in that kind of low point in mid-2020. If you're talking about businesses that are in manufacturing and heavy industries, kind of that B2B world, that will be a mild recession that will go through the midpoint of 2020 before we start to see some signs of a recovery and a turnaround happen as we get into that latter part of next year and certainly into 2021.
So speaking of the slowdowns and pickups, what are what macroeconomic factors are we looking at that will cause them to slow down or pick back up?
There's a lot to it, as with anything economic, the devil's in the details. So part of it is just the underlying business cycle. You have to understand the economy goes through these periods of swell and then slow down on a fairly regular basis. Roughly speaking, we see a recession about 10 to 11 years apart. And then within that 10 to 11 year cycle, there are 2 to 3 mini cycles where growth rates go up and down. If you would think of it as kind of a snake, a sinusoidal waveform pattern that repeats over time. So part of what we've got going on right now is obviously just the general ebb and flow of the US economy. we have been growing for a long time now. The last time we had a true recession was back in 08, 09. Over the last 10 years, we really haven't seen much of a contraction in any facet of the economy. There were a couple of areas of weakness, and you would technically call it a recession in the industrial side. For example, when oil prices collapsed back in 2015, 2016, we saw a mild industrial recession. But GDP, our broadest measure of economic activity, has been on a tear for basically 10 years. And when you look at the economy the way that it is today, it's 20% larger than it was at the pre-recession peak back in 07. And so it's really natural and normal for the economy to cool off, to get a chance to absorb some of that growth that we've seen, and certainly to position itself for the next rising trend. So the specific factors I would point to is we still have a relatively strong consumer, but we do see some slowdown in things like disposable personal income. People are obviously exposed to all the media and all the news around them, people talking about the recession more, kind of the fears associated with kind of the yield curve inversion happening. I'm sure you've heard about that some, basically as the signal of the next recessionary period. And it becomes a bit of a self-fulfilling prophecy. When you hear about a bunch of negativity, you decide, well, maybe I'm not going to go on that fancy date or on that vacation. Maybe I'll delay the purchase of my car. And so there is a bit of a slowdown happening in retail sales in the consumer segment. But I would say that the bigger driver has been, of course, the industrials and specifically things like the trade war. Obviously, that's had a major impact. More than anything else, I would say it has introduced a great deal of uncertainty for businesses. They don't know how bad it's going to get. They don't know when it's going to be over. They're tightening the belt a little bit. They're not investing as much. They're not hiring as many people as they were in previous years. So these are some of the factors that we're seeing as kind of the underpinning of the slowdown that's emerging right now. And there will certainly be the factors that will eventually culminate in that mild downturn in the industrial sector next year.
Now, of course, we are all in the real estate business, and so we're interested to hear how you view the real estate business and the real estate industry as perhaps separate, than the economy as a whole. If you see it moving along those same paths, and whether it will be slightly behind, slightly ahead, less affected, more affected. Residential and commercial real estate in the United States in the near and extended future.
So it's a really interesting dynamic, actually. The relationship that these different segments of the economy have to the overall environment are quite different sometimes. So, for instance, when you look at residential real estate, it's typically kind of known as the canary in the coal mine. It leads the economy. It has some predictive ability. And currently, if you look at housing starts as one measure of residential activity, they are down year over year. Now, the positive news is we've had an interesting reversal of what we call internal trends. It's basically looking at growth rates more short term rather than long term, and then inferring from that where the longer term rates of change are heading. So what we've seen, especially in the last couple of months, is a real nice uptick in the shorter term growth rates, which really kind of supports that expectation that we have of the recovery and the improvement in economic conditions in the second half of next year, post that low point. Now, if you look at the flip side, the non-residential sector is typically a laggard to the economy to the tune of about 12 months. And that makes sense. It's only when businesses and companies start to feel really good that they decide to invest and buy a new building or build one. And then it takes time for all of that activity to unfold. So it's about a year laggard, and that is still up year over year, but it's clearly starting to show signs of the slowdown. We expect that the non-res sector will feel the kind of slowdown that we're feeling in the overall economy now. That will be the name of the game for non-res when we get into the latter part of 2020. So next year, there'll be softening. But I want to preface that by saying that I generally am a big believer in real estate as a long-term vehicle. I come from a foreign country. So I was born in Kiev, Ukraine, when it was still part of the Soviet Union, and I emigrated to the United States when I was 10 years old. And in observing the way that this amazing capitalist machine works, I've come to understand that really, there's two different types of ways that you can kind of break through the paycheck to paycheck lifestyle. I think that the first one is you start a business and you're one of the successful people that actually manages to grow that business and eventually to cash out, whether you sell it or you go public or whatever it is that you do. And the second aspect of that is long-term investment in real estate, whether it's residential or non-residential. I think that the name of the game has changed in terms of how you play that investment. It's no longer the idea that you want to grow the actual underlying asset value as much as it is as generating cash flow. So I believe that it is, with the low interest rate environment that we're still in right now, if your investment horizon is, 10, 20, 30 years into the future, I still think that despite what may be going on in the near term in the housing market or in the non-res sector, I think it represents a really good opportunity long term.
And that's pretty much exactly what we've been, telling our clients as well. Obviously, prices are high, but it still may be a great time to get in because of those interest rates. Now, our last, we really felt that recession in 08, 09, and so we may have a skewed perception of it as being, one of the darkest financial times in a long history. And maybe we just felt that more acutely. Would you say that the 08, 09 depression was of the magnitude of the Great Depression, and as it has been driven an analogy to, and will that in turn maybe extend what is normally a 10-year cycle because it was so severe? Might we see the next downturn maybe extended because of the severity of that?
Yeah, so I think that there was a lot of very unique factors that went into the housing bubble downturn that we saw in 08, 09. And the primary culprit, I'd say, would be the speculative buying that was going on. There was very, very little kind of policing of the loans that were being given out to people by the banks. It was kind of a wild, wild west of real estate. I do think that we have learned some lessons from that. For instance, when we look at, when we hear people say, well, there's another housing bubble forming, that may be happening in some very specific markets in terms of price. You look at San Francisco, certainly many areas of California, you look at Boston. A lot of those places are, priced to a point where I think it is unhealthy. The pricing cost prices many people out of the market. And interestingly enough, that was actually driven not by speculative buying, but by foreign buying. If you look at the way that, for example, the Chinese or wealthy Russians or Brazilians have been coming in and trying to take money out of their country and put it into a relatively safe haven asset, well, prime real estate in the top country market, in the top city markets here in the US has been kind of the name of the game. So I think, yes, from a pricing perspective, there is a bubble, but from a general market condition, I certainly see no bubble at all. In fact, I think that primarily what we have is a shortage of the affordable kind of entry-level properties. Builders are really struggling to turn those out at a profit. And so they've shifted some of the focus lately to not only multi-tenant housing like apartments and condos, but kind of some of the mid to upper tier housing, houses above 350,000, above 500,000. So I think that when you see the way that the consumer is behaving regarding housing and real estate in general, we track a series called delinquency rates. It means what percentage of loans are being defaulted on. And the residential mortgage delinquency rate is at a very, very low level right now. It continues to decline. So I don't think that the American public has bitten off more than it can chew the way that it had in 07 and 08. So I still think that if you're looking in the right place, if you're looking at the finances and being smart about it, I still believe that a real estate investment, certainly if you want to buy a home for yourself, in my opinion, you got to do it. You got to do it as early as you can. And if you can swing it, try to get that 15-year mortgage with a lower interest rate. Because, boy, if I could talk to myself when I was in my
right.
Put it very simply, if you do that and you're able to handle that responsibility, you've got a paid off property by the time you're 40. And then that's either free housing for you, or you can turn it into some mailbox money, checks coming in if you want to turn it into a rental. It's just a really good long-term play. Now, Of course, there are drawbacks. You've got to be your own landlord. You've got to be responsible for fixing things, and you've got to be very diligent about making sure you make those monthly payments on a regular basis. But if you can be well behaved and make sure you follow the rules, and I still think it makes a great sense to get a house, especially for those millennials, the older millennials now that are in their early 30s. They're getting married, they're having kids, they want a yard for their kid and their dog to play in. They're really looking to buy, and it's a hard time for them right now because the properties just aren't there. It's very much a seller's market right now.
I've been seeing statistics that demographic of people are not buying homes at the regularity that previous generations have at that same age.
Yeah, data is really funny. You can take any study and interpret it any way that you want.
Yeah, this was a Facebook headline.
It's obviously true. But what I would say is what we're seeing is that there's clearly been a delay. Like this failure to launch issue has clearly been there. Student loan debt coming out of college into the Great Recession or the immediate aftermath. It really has caused, if I were to put some numbers to it, I would say, traditionally speaking, at least for me, I'm 40 now. I got married at 25. We had a nice 5-year period with my wife of dink lifestyle, double income, no kids. It's that awesome thing to enjoy. By the time we were 27, we bought our first house. And by the time we were 30, we were having kids. What you're seeing with the younger generations is all of those things are still happening. They're just happening later on. So perhaps they're buying a house at 30, they're getting married in their early 30s, waiting until mid 30s to have kids. But all of the things that we want from life, having a place to call your own, building some equity in the long term, and really enjoying the long-term stability that a house represents. I think those are still very much wanted by the millennial generation.
And I like your analogy about the snake and how it kind of, our economy is really kind of rolls and it goes up and it goes down. And I know that we're going to continue to have some lows and then it'll go up and go down. But can you tell us specifically, Q4, it's going to go down, Q1 and 2, it's going to go down, Q3 and Q4 of next year, it'll go back up. And when will we really see it kind of go back into maybe another version of our Great Depression?
Yeah, so I can talk about it in two ways. I can tell you what our current thinking is, and I can also tell you what could impact that thinking. So the current situation is we are expecting deceleration in both the GDP, meaning consumer-driven economy, and in the industrial sector through the rest of this year, through the first and second quarter, and that low point in the snake happening in mid-2020. At that point, we're hoping to see some economic rise and eventually get back into positive territory for the industrials by late 2020. And certainly we expect 2021 to be a growth year for the economy as a whole. But there are so many things right now that could derail that thinking. And what we do is we pay attention to leading indicators, which are essentially data series that accurately predict what the economy is going to do. And right now, I can tell you the leading indicators are clearly pointing to the downside aspect of what I'm talking about. Very few of them, as of right now, are actually talking about that upswing. Now, we have had that turnaround in housing that I mentioned earlier. That's a positive development for the second half of next year. We have had a rebound in cash holdings by corporations. We've had a rebound in the profitability metrics. The delinquency rates of businesses are starting to improve a little bit, but these are still not enough to confirm with 100% kind of certainty that we're going to have that rising trend specifically in the third quarter of 2020. What is going to determine that, I think, are two things. Number one, what do we do in terms of trade, right? Do we continue to ramp up the rhetoric and the tariffs that exist? Do we continue to make it more difficult for businesses to be profitable? Do we continue to do things that make things more expensive for consumers? You know that we just recently increased tariffs on a lot of Chinese products. We did delay many of the consumer-facing products like electronics and iPads and all those kind of things until mid-December, but eventually it will catch up. And the reason why all of that is important is because of a concept called elasticity of demand. It basically means that as things become more expensive, we buy fewer of those things. So if we continue to increase the tension in the trade wars with China, certainly, if we fail to ratify the new USMCA, which is the replacement of the NAFTA trade agreement, if we negotiate from a hardline position with Europe, with Japan, all of these things that are going on regarding trade, I think it's going to potentially push that low point further out. And what concerns me about that is that we're really not seeing a great deal of positive momentum, positive developments as of right now. Now, the flip side to that negativity is we're coming up onto an election year, and that's an important concept. I certainly think that, without getting political about it, and that's an important point to make, we are apolitical at ITR. We don't have a preference for the left or the right viewpoint. We look at data, we leverage that data to inform our decision making. And right now, as we head into 2020, the big question becomes, what does the administration and President Trump, what do they do to really stimulate opinion in people and make them feel like he's the right choice for this country moving forward? We've already seen some talk about potentially dialing back those trade conflicts. We've seen some talk about a infrastructure package that addresses the nation's roads and bridges and things of that nature. That could be a nice little boost. We've heard some rumors about another potential tax reform package targeting middle class. So I think that, in my opinion, and this just makes sense to me, that the administration is going to want to be stimulative. They want the economy to do well as we head into that 2020 presidential election. And so that could be the positive upside to the forecast. But we're not going to speculate about what actually happens. And so as of right now, our position, we have a low point in the economy, mid-2020, some mild rise in the second half of next year, and then 2021 is really going to be the next growth period for the U.S. economy.
And I'm getting a lot of questions from home sellers. I'm kind of boots on the grounds. Hey, what do you see for the forecast for the U.S. economy? Is my house? Am I smart to get out of this house now while prices are at a high? Do you see an impending cliff? And I go a little deeper into that subject of the 2020 election, because I think that any forecast of the economy diverges dramatically. I mean, I see right now as the front runner of the Democratic Party to be Bernie Sanders, and an election of Bernie Sanders or an election of Donald Trump, in my opinion, there is a drastic difference in the next year of the economy after one of those two things happening. I do not think it plays out the exact same way no matter who is elected.
Yeah, I think that there is some truth to that, but what I can tell you is we track this fairly consistently over the past 10 administrations, and that economic cycle, it really does not sway greatly from a Democrat to a Republican. Now, I understand that your point about the ideologies of Bernie Sanders versus Donald Trump. But, you can also say that Donald Trump has not been the quintessential Republican president, in the sense that typically Republicans are fiscally conservative and they focus on debt reduction and they don't want to spend a lot of money. That has not been the case for the administration. The other component of it, I would say, is anytime there's a change in leadership, it takes time for the platform to unfold itself. What I mean by that is, if you look at when Donald Trump was first elected, right, the U.S. Economy had already started its rising trend in early to mid 2016. So yes, certainly the president has done things to stimulate the economy, but the rates of change started to improve still under Barack Obama's watch. And you have to understand that economic cycle, it really takes a long time for political developments and certainly for regulatory developments to affect the change. If you look at President Trump's kind of platform, health reform, right? We spent a year, the first year of his presidency, trying to pass kind of a change to the healthcare package. That didn't go anywhere. We talked about infrastructure spending. We talked about many things, but it takes time. And really the first substantial thing that we saw from President Trump that change the profile of the economy was the tax reform package that we saw really affect things in 2018. So yes, certainly different ideologies on Bernie's or Elizabeth Warren or any of the other candidates, even Joe Biden, who seemed as a more moderate right political figure on the left. Different ideologies may come to bear, but it's going to be a while. And so when we look at 2020 and certainly into 2021, we don't expect a great deal of change to the economic cycle, regardless of who is going to be our next president.
One thing that I've, go ahead, Heather.
Oh, sorry. Yeah, I was just going to say, we have a lot of leaders that listen to this podcast. And, I believe that whether the economy is fast or slow, talent is your biggest asset as a leader within your company to have, no matter which way the economy is going. So what are your thoughts on this? Like, what do you think about the talent level that we need to have, whether we're going into a slow quarters or, as we, in 2021, maybe pick up again? What's your thoughts on the talent?
Absolutely, Heather. So I think I could not agree with you more on this subject. I think talent is critically important. Right now, despite the fact that we're post the peak, my focus when I'm talking to businesses large and small is on retention of your employees, especially the stars in your organization. You got to make sure that they stick around. You have to understand, despite the fact that we're talking about a slowdown and then even a mild recession in the industrial economy, it's going to be brief, it's going to be mild, and we're going to be back up into a positive trend relatively soon. So leverage this period of kind of slowdown to cross-train your people, to get their skill levels up, make sure that you're accounting for that next rising trend and not looking to layoffs as the lever that you pull despite the fact that business is slowing. So I think absolutely that they're going to need those people. They're going to need to make sure that those people are ready to take on different and evolving roles into the future. And so continue to hire. It's going to be difficult because the job market is extremely tight. There's tons of open positions right now. It's certainly an employee type of market right there now rather than a hiring company market. And so I would say make sure you're having those direct, frank, and honest conversations with your people. Make sure you understand what is motivating them to continue to work for you. Make sure that you give them the messaging that you want to help them get where they want to be. And so if that's not happening right now, let's have that discussion. And at the same time, set clear expectations for what you need them to achieve to help you get where you want to be. But I certainly think that looking to layoffs as a means of offsetting some of the pressure over the next 12 to 18 months, I think is not what I would recommend to businesses to do. It's going to continue to be very important to keep people on board. Having said that, the asterisk is if there are people in your organization that are clearly not performing, right? You can look at it from a people perspective or products or services. They're what we call like the losers in the organization, right? Well, it's not a judgment of any individual. It's just saying underperforming assets. Let's call it that. During a period of slowdown, you cannot afford to spend time, resources, and money on these losers in your organization, whether they be human beings or products or services. And so you've got to cut them and focus on the parts of your business that are more profitable, right? So that has to be taken in context of what I said earlier. Generally speaking, yes, staff retention is key, but also, if you know that person is not doing what you need them to be doing, don't spend a lot of time on them. Focus on the areas of your business that are going to make for a good ROI.
Now, I want to ask you, because one of the things we've noticed in real estate, and this has happened every time that I've seen it in real estate, that anytime we have a big election, about 3 to 5 months before that big election in real estate, we really slow down because it's almost like people get like deer in headlights and they don't know what to do. And they're like, especially, before when the last Trump election, they were like, well, we don't know who's going to get elected. And it's almost like they freeze. And so you just said that you feel like there's going to be an uptick in 2020 next year, midway, which would be around the 3 to 5 months before the next big election. So clarify that for me just a little bit.
Again, the timing of that uptick is still, I think, relatively up in the air. We have plenty of evidence that points to the downside. We're still looking for confirmable and enough of a body of evidence to confirm the rising trend. What that timing is based upon is really when you look at the economy and you look at the typical performance. So when the industrial production index or GDP enters a deceleration trend, it usually lasts somewhere between, let's say, 12 and 15 months. Sometimes it can be 18 months, sometimes it can be shorter than that. But when we go to forecast longer term, beyond what leading indicators are going to be able to tell us, we have to look at what is typical behavior for an economy. And in the nice part about the way we do our forecast is we can look at previous cases that are similar to what's going on right now. So when you look at the previous election years, how did the economy behave if it was in a slowing mode at that time? How long was that duration of the slowdown? And based on that analysis, that's why we currently have the viewpoint of mid-2020. But as I said earlier, there are both negative risk factors and positive risk factors to that forecast. So the key is to continue to pay attention to the data, because right now we're starting to see some tentative sign in the turnaround happening in some of the leading indicators. Other ones are pointing to more downside, which is why it can't be just a once a year or once every 6 months you listen to the latest talking head economists tell you about what they think. You've got to continue to pay attention. When the signs are there that the turnaround is real, that's when you tend to want to pull the trigger, despite of when related to the next presidential or midterm election that might be happening.
And I've heard, go ahead, Jmac.
Oh, I was just going to say, I guess it was maybe end of 2017, beginning of 2018. There was a lot of talk by the Fed of increasing interest rates. They did that a bunch of times in a row. And I feel like for the longest time now, the Fed has wanted to and has attempted to increase interest rates, and they always run into this glass ceilings and sort of get their hand smacked, and then it goes right back down. If you had to predict the trend specifically in interest rates, how would you talk about that?
Well, I think that you have to think about the kind of prerogative that the Fed has. They are trying to manage two things. That is employment and it's inflation. And what we've seen is that inflation, especially in certain key parts of the market like commodity prices, was up much higher. The producer price index, for instance, was up around 4% midpoint last year, in part due to the tariffs on steel and aluminum imports and that kind of thing. And so I think that there was some impetus for them to raise those rates when they did. Now, at the pace that they did, how many rate hikes they did, I'm not going to be the judge of that, but I can tell you there was some underlying evidence of that happening. Now, inflation is currently down. It's much lower from a pressure perspective than it was at this time last year. The job market continues to be tight. And so there is some reasonable explanation for why they are doing this tempered approach to slowly dialing back the rates as they see more risk factors emerge for the economy at large. Now, when you look to the future, certainly over the next 2 to 3 quarters, we expect more of the same, perhaps 1 or 2 more small interest rate interest rate declines relative to where we are right now. Nothing significantly different, but certainly if the economic pressures start to build up, there will be more impetus for them to lower those rates as a means of stimulating the economy a little bit. From a home buying perspective, I understand that it makes a difference for people, but I understand where rates are today is already so low by historic standards that 0.25 percentage point difference is not going to mean a great deal of change for you. What really impacts is the total picture, right? The home value, the affordability factor, certainly interest rates are a part of that. But I would say if you're looking for a home right now and you find one that you love and it's within your price range, don't delay buying just because you expect another 0.25% decline in interest rate policy. That would be my advice.
And I've heard you say in a previous talk that things are kind of going to be up and down. And then in 2028 is when you really think that's when we're going to have kind of similar to the Great Depression. Is that right? And if so, where should people put their money? And where would be the safest place for them to put their money? Because back when it was the Great Depression, people couldn't get their money out of the bank. So is the bank the best place to put it? And where is the safest place to put that money?
Yeah, so the Great Depression argument is really, you have to understand what is driving the logic there. It's predominantly two things. The first thing is the fact that we as a country continue to live beyond our means. We continue to spend more money than we have, and our debt, which is already at $22.5 trillion, is expected to continue rising by $1 trillion or more every year into the foreseeable future. So that's one thing. And we eventually do think that interest rates will rise, especially as we get into that mid to late 2020 timeframe. So the payments on that debt are going to be very difficult for the government to manage when interest rates are not at 2%, but rather at 5 or 6 or 7%. So we're not expecting the type of interest rates that we saw in the 80s, but certainly higher than they were today. The second component of what's driving that kind of Great Depression expectation is the demographic change, right? We've got 10,000 baby boomers that are retiring every single day between now and the year 2030. And basically, that's going to put such a strain on Social Security and Medicare and Medicaid that the government is going to have no choice but to do two things. The first thing they'll do is they'll shift spending away from all the other things that they do right now, like infrastructure and education and science and defense, to these entitlement programs, because it's going to take a lot more money to cover all of those retirees. The second thing that they're going to have to do is increase their own income. And the way that you do that is by raising taxes, both on individuals and on businesses. So when you've got a situation where you're raising taxes and cutting spending, and remember, the government is a big part of the economy. They account for about 17% of our total GDP. So when they're cutting spending and they're raising taxes on individuals and businesses, which will, of course, result in lower spending by those entities, that will culminate in a very difficult economic environment. Now, that's not guaranteed to happen. It's the likeliest outcome unless we somehow have a kind of bridging of positions in Congress and in the House and between the administration. The two sides of the aisle all of a sudden want to work together and fix these problems, right? Address the shortcoming in Social Security and Medicare, address the fact that we continue to spend more than we earn. I personally don't see that happening. I don't know if you have different opinions, but I think that that's very unlikely. So the likeliest scenario that we see right now is the United States does go into a very difficult economic period in the 2030s, really kind of 5 to 7 years, because by the year 2036, actually more than half of the baby boomers will have, how do I put this politically correctly? Let's say sail off into the sunset, right? So they will be lessening the strain on the federal government and their spending. And so things will improve. But during that 5 to 7 year period, we are expecting a more significant downturn than what we saw in 08-09. And the reason why we call it the Great Depression rather than a Great Recession is because it'll remind us more of that 1929 timeframe. Now, to your question, where do you put assets? So the logic is you've got to look for places that are going to continue to be in demand, that people will still need. And you also have to look outside of the US. So I mentioned debt and demographic change are really difficult in our economic future. It's not the same, for example, for a country like Canada that has managed their position much better. It's not the same for Australia that has a much lower debt threshold and a different demographic mix to their population. Switzerland is another one. So one of the strategies that we're recommending is keeping money outside of the US. Another strategy is to invest in asset classes that appreciate as inflation picks up, because we do expect prices to rise. And certainly property is one of those as a lead up into that Great Depression. We expect prices to rise for property. But beyond that, what I also like about property is that let's play it very rationally, right? Even if that property is not going to be the big ROI in terms of asset appreciation, it's a physical asset. And if you have family members that are really hard up during that period of time, it's a place for them to live. So I think when you talk about housing in particular, I think that's a good place to look for long-term stability.
Awesome. Well, thank you so much for joining us today. And if people want to, I know you do speaking engagements. If people want to learn more about you and your company and ITR, tell them where they can find you.
Absolutely. I think that the easiest place is to just visit our website, which is www.itraeconomics.com. Alternatively, you can reach us on Twitter or Facebook or LinkedIn. We have profiles there. And the last thing that I'll mention is if you want to know more about that 2030s Great Depression and some strategies that you can implement. The owners of my firm wrote a really good book that I actually read before I joined the company. It's called Prosperity in the Age of Decline. It outlines what we've talked about today in more detail, and it gives you some of those strategies that Chantel was asking me about. So I hope you pick up the book. It's on Amazon, it's on our website, and certainly please do reach out to us. I'd love to come and speak to your audience.
Awesome. Well, thank you guys so much. And thank you to my co-host. You guys have an amazing day. We'll see you next time. Bye-bye.
Take care.
Thanks for listening to this episode of Real Life Leadership. If you'd like to get the show notes or access more resources, log on to reallifeleaders.com/podcast to get the show notes from this episode and any other resources we might have mentioned. And also, we'd love to hear from you. Be sure to review or rate this podcast on Apple Podcasts to help spread the word. And if you have any leadership questions you want answered, email podcast@reallifeleaders.com.